AI was trained on decades of financial data, behavioral psychology research, and consumer spending patterns, and one conclusion became unavoidable. Debt feels normal, not because it's healthy, but because the system made it feel invisible. In this video, we're going to break down why debt became the default setting for modern life, how companies engineered this behavior, and why most people don't even realize it's happening. Historically, debt was a temporary bridge, a tool used rarely and repaid quickly. But according to AI's analysis, something changed in the late 20th century. Banks, credit card companies, and later tech platforms discovered a powerful truth. People buy more when they don't feel the full price up front, so companies redesigned the buying experience. Instead of asking consumers to purchase something outright, they introduced monthly payments, installments, financing, and credit lines. The goal wasn't affordability. The goal was lowering psychological resistance. AI found that the human brain processes numbers emotionally, not mathematically. When presented with a £200 in purchase, most people hesitate. But when that same item is framed as only £35 per month, the hesitation disappears. The object didn't get cheaper, but it felt cheaper. The gap between price and perception is where normalized debt lives. Companies learned that they don't just sell products, they sell affordable feelings. AI's economic models revealed another layer. Real wages in many developed countries flattened, while the cost of essential goods climbed, especially housing, education, and healthcare. Debt filled the gap. Instead of prices coming down, financing options went up. This created the illusion that everything was still within reach. A student can't afford tuition, student loans, a household can't afford a car up front, 0% financing for 60 months, a family can't afford a home, 30-year mortgages. Debt became the lubricant that kept the consumer economy moving. AI found a powerful insight. Debt doesn't just spend money, it spends time. When someone finances a purchase, they are committing future hours of labor, hours they haven't lived yet. This is why credit card balances grow quietly. The brain doesn't translate debt into hours worked, it translates it into delayed inconvenience. Companies learned that the most profitable customers are not the ones who pay in full. They're the ones who buy time they don't have, using money they haven't earned, for lifestyles they can't sustain. AI highlighted three forces that made debt feel ordinary. 1. Cultural normalization. Debt went from taboo to a milestone. Credit scores replaced savings as the measure of stability. 2. System design. From checkout screens to subscription services, everything defaults to recurring payments. 3. Social comparison. Many people imitate lifestyles financed by credit, not income. This makes debt look like prosperity. When everyone is financing their car, phone, furniture, education, and holidays, it no longer feels like borrowing. It feels like participation. According to AI, the reason debt feels normal isn't because it stopped being expensive. It's because it stopped being visible. Debt is embedded into products, into society, and into identity. People don't buy price tags anymore, they buy monthly payments, and the system prefers it that way.